Is my money safe? That is what I asked myself when I saw the stock prices tumbling back in March. I fell into a routine of constantly watching the stock prices. I would set up alerts on my phone to give me the peace of mind that I knew what was happening as soon as it happened. In reality, I just fueled a whole heap of financial anxiety as I watched many of those well-known companies declare bankruptcy. This got me thinking. As well as the bankruptcy risk facing the underlying companies that my ETFs track, what if the ETF company itself goes bankrupt? So I did what I do best. I researched. What I found sent me into a whirlwind of despair, and I sold all of my stocks. No, I didn't. Instead, what I found was thankfully that someone way smarter than me had already thought about this risk, and there are rules in place to make sure that ETFs are set up to be independent from the fund company. Bankers call this bankruptcy remote. So this means that the ETFs are set up as separate legal entities to the companies who administer them, such as Vanguard, Blackrock iShares and Invesco PowerShares. And so if the worst did happen and the companies went bankrupt, then the ETFs should remain unaffected. The fund employs a board of directors who oversee the running of the ETF. They ensure that the right quantity of shares in the underlying index are purchased and sold, ensure that the dividends are distributed, and ensure that the ETF is rebalanced. Crucially, these ETFs are set up as separate corporate entities, and so effectively hire the fund company to manage its assets. In the event that the fund company went bankrupt, then they couldn't touch the fund, and the fund would just appoint a new fund company to manage the investments. For example, if Blackrock was to be declared bankrupt, the iShares ETFs which they manage would remain as separate entities and would look to appoint a new fund company. This is the same for all fund companies. Vanguard, however, is in a uniquely secure position, which is definitely worth mentioning, as their funds are set up to be client-owned. Let's take for instance the Vanguard FTSE 100 ETF VUKE, V-U-K-E. The ETF is set up as its own entity, just like the Vanguard S&P 500 ETF VUSA, VFEM, VUR, you get the picture. The Vanguard Group is then a subsidiary of these. This means that part of the cash in each of the funds goes to the fund company, and not the other way around. That means that each fund is actually a part owner of the Vanguard Group. The best way to imagine this is to actually think of the Volkswagen Group. So you have the Volkswagen Group at the top as a corporate parent, and underneath you have Seat, Skoda and Audi. Now, just flip it all around and imagine the individual brands as the parents and the Volkswagen Group as the subsidiary. Once you've got your head around this incredibly complex procedure, then just switch out the Volkswagen Group for the Vanguard Group, and each of the individual brands are each individual ETFs. What this means is that actually the bankruptcy of the group is incredibly improbable, as each of the ETFs contribute to the group, and so if one of the ETFs failed, then the group would not. The only way the Vanguard Group could go bankrupt is if all 74 ETFs failed. And let's face it, if that's the case, we've probably got bigger problems in the stock market going on. Although it is true that if one of the ETFs failed, it'd likely have a snowball effect on the whole for Vanguard, meaning that multiple ETFs might fail. But overall, this is very, very unlikely, and so the question of bankruptcy for Vanguard is largely theoretical. For other fund companies, it's also very unlikely, and in a case that they did go bankrupt, then your funds would be safe and secure. This means that it isn't so important to diversify across fund providers in order to hedge against them going bankrupt. Now, I'm not saying that you shouldn't look to have ETFs that are provided by different companies. I'm just saying that if you are purposely choosing different fund providers for the sole reason that you don't want to have all of your eggs in one basket, then perhaps you'd be better off being more concerned with owning the best ETFs for what you're looking to track than just for the sake of having different fund companies. For example, you might usually buy Vanguard ETFs, and let's face it, they're pretty good ETFs. And so if whilst you're doing your research you find a great ETF administered by Vanguard, say VUSA, VUSA, then you shouldn't be too concerned that your portfolio is too focused on Vanguard funds. Instead, just make sure that the ETF is the best for what you're looking to track. If you're looking to track the FTSE 100, you could get the Vanguard ETF VUKE, with an expense ratio of 0.09%. Or you could get the iShares FTSE 100 ETF ISF, with an expense ratio of just 0.07%. And if by chance you actually are thinking about investing in a FTSE ETF, check out my ETF review. I'll leave a link in the description. So the risk of your fund company going bankrupt is pretty remote, to be honest. But if the worst did happen and they was declared bankrupt, then your funds would be safe in the hands of a custodian and completely separate from the fund company. Although in reality, you might see some short-term impacts such as the tracking error increasing or the net assets of the ETF decreasing significantly as soon as the ETF is unfrozen. This means that the bankruptcy of the fund provider isn't something that concerns me too much. Instead, what does concern me is dodgy and poorly managed ETFs, which are guaranteed to empty your bank account in just a matter of weeks. To protect investors against these ETFs, the European Union thankfully has some regulation in place to make sure that the funds are sufficiently diversified and liquid. Now, these ETFs are branded with the name UCITS, such as Vanguard Euro Stoxx 50 UCITS ETF, which stands for Undertakings for the Collective Investment in Transferable Securities. Yep, it's quite a mouthful. It sounds boring, and the truth is, it is, but it's also incredibly important. UCITS ETFs basically mean that they can be registered in the EU, and then they don't have to meet national regulation for each of the individual EU member states. For example, the Euro Stoxx 50 UCITS ETF can be traded within the EU without having to meet any of the individual member states' regulation. The UCITS ETFs can be traded across the world, with investors confident that the ETFs have met a certain standard. They still need to meet national regulation when outside of Europe, but they're very, very popular still. In fact, 70 to 80% of public funds in Asia are actually UCITS. Fund providers are keen to meet UCITS standards, as it's like getting a stamp of approval. And sometimes even in the marketing you see UCITS compliant. But what are those standards? Well, first, the fund has to be diversified. A single constituent can't hold more than 20% of the net assets within the ETF. That's just to make sure that the risk is spread across many constituents. Second, the ETF assets must be separated from the fund company by an independent custodian. Like we talked about earlier, ETFs must be kept separate so that they are protected from bankruptcy, or so that the fund company can't dip into the fund when they're short on change. It also means that the police can't seize the assets if the fund provider does something illegal, which has never happened before. One of the other benefits that UCITS regulation brings is that it requires ETFs to publish a key investor document, a prospectus, and annual reports. This is aimed at improving transparency, and so you can thank them for the hundreds of pages of documents you need to sift through before your next investment. The ETF must also be liquid, so that if the market crashes and investors want to sell up and get out, they can do. This requirement was added in 2009 and is still a little grey, to be honest. The directive says that the fund provider must take appropriate action to address liquidity risk, which they define as the risk that a position in a UCITS portfolio cannot be sold, liquidated, or closed at limited cost in an adequately short time frame, and that the ability of the UCITS to repurpose or redeem its units at the request of any unit holder is thereby compromised. Again, quite a mouthful, but incredibly important. How much they address the risk is left up to individual interpretation, and is addressed on a case-by-case basis. But you can still take some peace of mind knowing that there's measures in place to make sure that you can get the money out if the worst did happen. As well as the risk that the fund provider goes bankrupt, you also carry a small risk that the person who you buy and sell the shares through, the broker, goes bankrupt. Well, thankfully, it's actually much the same. The investor's money has to be kept separate from the broker's, and this was actually seen as recently as 2018 when Beaufort Securities was placed in special administration by UK regulators. It became clear that their own assets wouldn't cover the cost of the administration fees, and so their proposal was actually for all of the investors to take a haircut. Thankfully, the Financial Services Compensation Scheme stepped in, and that didn't happen. Once the bankruptcy process begins, the court will assign a trustee to look after your accounts whilst they look into your previous broker's accounting records. Then the process begins to start moving you across to a new broker. At that point, you can either continue with the new broker or sell up. One thing you should know about though is that they are going to freeze your accounts. And as we all know, time is money. But if you do feel like you've lost money during this process, you can claim up to £85,000 through the Financial Services Compensation Scheme. So remember that no matter what is going on at the moment with the economy, you should rest assured knowing that measures are in place to protect you as an individual investor. The chances of a fund company going bankrupt are pretty slim. If they did, your investments in ETFs would be safe as they are kept separately from the fund company. Although you still need to make sure you're investing in quality ETFs, which aren't a complete money sink. And one way of doing this is by investing in UCITS ETFs, which have met certain regulations to make sure that the ETF is sufficiently diversified, has good liquidity, and the fund is transparent by publishing a whole host of useful documents. And lastly, if your broker goes bust, your account will be frozen and can't be touched, which is quite annoying. But if you lose money because of this, you can make a claim up to £85,000 here in the UK. Although I would suggest doing some research and just making sure that the broker is well regarded, just to try and save yourself the headache of going through this process. If you're interested to see which ETFs I think are good quality and which ones I think you should stay a million miles away, then make sure you follow the channel and just keep an eye open for the ETF reviews.